The SharePickers Podcast.
And joining me on the podcast and on video, it's Vadim Alexandre, Head of Healthcare, SP Angel. You're right, Vadim?
How are you, Justin?
Yeah, not too bad. Market's in a bit of a funny place. We've had a rally. We're trying to break up. In fact, let me straight the charts. I want to get the AIM all shakes. It was looking good, and then the American markets sold off, and it dragged us down a little bit. But it was heading towards a breakout. And then it didn't. But I think that's
the whole Iran war thing and everything, like that didn't help. So that
level there, I mean, a few days back, it literally touched that 763 on the AIM all share, which is a recent high, and if it gets above that, it's very bullish. But like I said, we had American markets selling off. And let's be honest, the American market going bananas. The S&P 500 has gone bananas. It really is. And I did point out this. A couple of people saying, look at where it's gone. If you just take off, like I keep saying, is it overbought? Well, look at the gap between the S&P 500 and the 200 moving average. If you scroll back and look at any time in the past 10, 20 years, it hasn't been this much of a gap ever. So it's left that and taken off. Yeah, it's like 13% above it. So of course it's well,
look at it's adjusting now, and Tesla's come down a lot because they're having issues. So no surprise, gravity is kicking in.
Yeah, and in fact, one of the big stocks here. In fact, some of my sons own some American stock, but Nvidia, which has been the big rally. I mean, you can see almost like the S&P. It's now rolling over a little bit. So it's good that the American market's cool. I don't know if they're going to just fall back. They've got a lot of earnings out this quarter. I know that, but a lot of the companies are good, aren't they? A lot of the big companies are fundamentally good. They're maybe a little bit overvalued,
but they're rolling over. Just have a quick look at Tesla. That's one of the. This is the one we have there. And Nvidia, the Magnificent Seven.
Just look at the market caps of these yesterday. Nvidia, $2 trillion. Right? Amazon, right? It's 1.8 trillion. So it's bigger than Amazon. Apple is also 2.6 trillion, but the biggest one, of course, is Microsoft, which very powers away 3 trillion. But Tesla, it's been having a bit of a nightmare. It's 400. It's like a small cap now. 495.
It's only half a trillion, but
it's only half a trillion. Yeah. But look at that. So if you scroll back, you can see there it's gone from $416. It's now $155. And it's in
but you see the rally. Look at that rally, just the where it broke through the 200 upwards. Right there, exactly. So that was the rally. That was the Magnificent Seven, like mega rally that's dragged the whole S&P up, right? There's been a few anyway. So my main point is that now several of them are rolling over. Some of them are collapsing. So look, that's it. One debate was, are the small caps going to catch up, or are the large caps overvalued? And it looks like it's a bit of both, right?
Yeah.
So the small caps, the Russell 2000 has rallied like 28%, 30%, but that's nothing compared to what the Magnificent Seven have done, comparatively speaking. And then the Magnificent Seven, over rallied. So now they're coming back.
Yeah. And if you're listening or watching this thing, why are you talking about American stocks? Because it's like the moon. It does affect, our tides. It does affect our markets a lot. That's the Russell 2000, by the way. Like I said, from May 2022, it's come down and hit this sort of 1,635, and it's in the range then between 1,635 and 2,000. And it sort of broke above that, but now it's back in that range. It broke above that, back in December, then dipped down. Then it broke back above that in February, and it went up to 2,100 pretty much, and now it's back at 1,947. So it's back in that range. And I think they're finally catching on that interest rates in America are going to be higher for longer. And in fact, that brings us around to over here, essentially, we had inflation data out. And it's funny that, they were predicting, I think, 3.1%, the overall figure.
Yeah.
And it went to 3.2, which is still less than last month. But the issue is, and I was just worth listening to a guy who's written a book, he's from the ex-Bank of England guy, talking about it's very complex to bring all inflation into one number. Because there's so many different parts of the economies, so many different goods and services. He said, so if you look at goods, that's coming down. But services are not. Service inflation, because the cost of living wage, or the national living wage has gone up. And so everyone has to put their money up, their wages up for that. And so that's running at just over 6%, service. And within that is rent inflation, and that's about 9%. And you have to understand, people put the rents up because they've got mortgages. The mortgages have gone up because the government have increased interest rates. I'm thinking, governments are playing into the inflation here. It doesn't help at all. Because
there's
renting.
Couple of things. One, I just want to before we move on to inflation, see this chart on the this is the Russell, right? Russell 2000. Yeah. Look at the peaks. So we haven't returned to anywhere near the previous highs, whereas the Magnificent Seven have exceeded.
Yeah.
Do you see what I mean? So the small caps market in the US by no means has caught up. It's still way below what the big tech companies have done in terms of rally. Now they are slowing now, and maybe they've overshot and they're coming back down. But the Russell 2000 genuinely hasn't returned to those highs of 2350, 2400. Do you see what I mean? So that rally hasn't caught up at all yet. Okay?
Yeah, look at what happened from $200 pretty much down to 168. The one that hasn't is slowing. Well, it is rolling over a bit. It's Microsoft. Nvidia is a little bit, and that's the question is here. That's the trouble. Will they roll over, and will that will we have contagion here, or will people just go to a smaller caps or go to different markets? Because the UK, we're not overvalued. We haven't got a hot economy. Like I said, there's probably a chance we may reduce interest rates before the US. And so, will we see money inflow from this, from the outflow from the Mag 7 pretty much? Because, or will everyone just become, risk averse and just sell everything pretty much?
It feels like this is the tragedy kind of that we suffer every time in the UK is the US stocks go up, ours don't follow. But then they come back down, ours follow down.
So we may as well just buy US stocks.
Unfortunately, that's part of the problem. Yeah.
But you know what? They're saying that there. Regardless of the economy, we're looking at indices pretty much in a couple of individual companies. But like I said, it's a market of stocks. There's always opportunity out there to buy good companies, I believe. And like I said, I've spent 2 years focusing on that. In fact, I've written a book about it because and in fact, the book isn't finished, but it's about how I've had to adjust my strategy over the last 2 years because I've gone gangbusters, from 2009 to 2021, and 2022 knocked me massively. And I thought, oh, hang on a sec, you've got to adjust. And when you realize you're going to do a higher interest rate environment, and I've never really had that. I've gone through 4 bear markets, or 4, and I've never really had a time where interest rates have been going up like this. And of course, pre-interest rates, when interest rates were low, it was like pre-revenue stocks were the place to be because raising money was easy, and it was all about future potential. Now that's not the case, and it won't be the case for a while, I think, because interest rates are not coming down fast. It's going to be slow. So I think
So on inflation, so it is actually the natural when you have, it wasn't runaway inflation, but we had a significant bout of inflation. And what we saw was exactly how inflation takes hold, right? So inflation starts in supply chain issues. So, input prices start going up, which is like commodity prices. Then we had the war and gas price issues, so these are all commodity type inputs, okay? And then what you have is then all of a sudden inflation expectations start growing and salaries start going up. The problem with salaries, comparatively speaking, is they're not as they're sticky. They're genuinely sticky. Think about it. Someone gets a raise, a 20% raise over 2 years. Is their salary ever going back down?
No,
and then they start getting an expectation that salaries should keep going up, right? Yeah. So I guess that's the point, is that now we're seeing the kind of the tail end of that inflation cycle, but it's the stickiest. So that's where we're having a problem of getting it all the way back down to 0 to 2%. And it seems to be sticky at around 3 to 3.5.
Well, that's it. Same with rents. Rents never come down. Yeah. Rents and salaries never come down. So it's food can, in fact, it can go up and come down a bit, but in fact, food is not back to where it was previously, but it's come down from the peak. But salaries and rents don't,
Exactly. But remember, it's not the actual fixed amount, right? It's inflation. It's not, it's not comparative. Meaning my point being is salaries keep going up because there's an expectation that salaries have to keep going up. Do you see what I mean? If they flatten, then that'll work. That'll stop the inflation, right? As in, remember, it's not disinflation we're talking about, right? It's not deflation we're talking about.
It's a slowing of inflation.
It's a slowing of inflation, exactly. So
the thing is with that as well is when you get for example, an employer that has a medium-sized employer has 1,000 employees, and they all have to put their wage up by 10% or whatever. Yeah. If they can't afford that, they end up laying people off. And so that negatively affects the economy, so it will slow the economy essentially because they can't not award people a living wage because it's part of the regulation. But
correct. And then the government, things like, salary adjustments are based on CPI. There's a lag, on wage inflation. And the expectations is the problem, is the thing we're trying to change. I think we have changed it. I just think it has to seep through the system. Wages started moving after the inputs started moving, right? Just exactly as you'd expect. The input prices moved first and then wages followed. And now, just as we're exiting, input prices move down first, or because input prices actually do deflate, right? So the cost of oil and gas has dropped, right? That is filtering through, and now wages are slowing, and that's the hope, is that it slows a bit more, and that's why we're stuck in this high rate environment for a bit longer. But it's punishing for stocks. There's 3 years of punishment.
Yeah, exactly. There's one thing that Andrew Bailey did say yesterday. He said he expects inflation to come down again next month because of the energy cap. The energy prices have dropped massively, but with that, you've got a national living wage being piled on. So it's a mix of two. So energy is going to drop out a lot lower, which will help the prices. But then you've got that the wage. But like I said, there's always opportunities out there. I mean, genuinely. I mean, I've had some. I literally have to change my strategy a lot recently in the last couple of years. But like I said, 2022 was a nightmare year. I lost money. This 2023 didn't, and now 2024 it's hard. It's hard going to find the stocks, but you have to be better. You learn. You don't learn anything from a bull market too much. You can learn, but you really have to learn to get good in a bear market. Otherwise, you just lose money. Full stop. And in fact, worth mentioning actually. Last time we mentioned Polarian, which is one of the stocks I held. In the bull market, and then
me too.
Did very well for me. Easy to raise money, excellent technology, and of course now they hit almost. It was a perfect storm because they were in the middle of. And I don't think investors understand this, because when it's easy to raise money, these are the stocks to be in. When it's not, they're pretty much not. and so, like I said, I was in there from 70. I think my average was about 30 pence. I think so. I was doing quite well, and then of course they had that knockback from the FDA. Then what happens, of course, when you got a loss-making company not generating any revenue, the two most important things is how much cash they got, how long will it last. You realise, so not only you got the bad news coming in, which was that big dip in the share price. There's also worry about financing, and that then becomes front and center of the story. The actual story, the potential. Doesn't. People start worrying about the finances, start selling. And so look at that. It's gone from £1.10, this stock, down to 3.8 pence. And the last time we mentioned this, I had some trolls on X having a go, saying, you're on play. I thought, what are you talking about? I mean, do you know what I understand? This is a message to the trolls. You shouldn't really feed them anything, but because they just get worse then. But when you're an investor, being an investor like anyone, it doesn't matter if you're good or bad. If you're very good, it's like being a musician. You don't have hit songs after hit songs. Every now and again, you'll have a dud, right? But hopefully, the hit songs you make will help you, and you'll make some money off them. And sometimes you can get it wrong. And this, I don't know what the percentage was, but it's like a 90% chance, wasn't it? FDA approval didn't happen. And so it went down, and so no one was expecting this. My issue is that I probably had too much money into it. So it dipped down, it bounced back up, and then I sold in the bounce. So I couldn't sell anyway on the down there. So I got out. And now I've still got people having a go at me on Polarian because they're in because I think I was in. Well, hang on a second. Why did you get in? What was the reason you got in? Just because I got in? So why didn't you get out when I got out? I thought, and so if you can just jump on other people's investments because you don't have your own ideas, you can't just blame other people. I didn't have the password to your stock market account. I didn't buy that for you. You bought it. It was your decision. Take ownership of that, and you will become a better investor. If you accept the losses as your losses, and it's your fault, you learn from it. If you don't accept it, then you won't learn from it because you don't see it as your fault. But literally, you can't blame other people for your investment ideas at all. For your investment losses, it's down to you, and that's to help you. You will get better. And when I started out, I was losing money all the time. I should jump on other people's tips, but I can't really blame anyone. So I realized it was me doing I was putting the money on. It's my fault. So it's just it's part of the deal. You have to accept. When you invest money, it's your money, it's your decision. Full stop. And if you you can't just take other people's advice and just go with it. And that's it. It doesn't work with that.
Another thing I think is important, and I think, I don't claim to do it very well myself, but when you're making an investment, you have to think about your exit strategy as well. You have to have a consideration of what are you in this for? Is it a horizon? Is it a time horizon? Is it a performance metric? Are you prepared to follow the story only and see how it goes? It's different strategies, right? So, for example, the Warren, anything from a day trader to the Warren Buffett strategy, every strategy is valid. It's just having one. You know what I mean? Having some concept of, why am I in this stock for? Obviously to make money, but over what period, to what end, how long, what am I looking for? A milestone in the business. There's a reason I'm buying this stock, which is to exit it at a gain, right? Part of the reason of the thinking, and I find this is just lost in investment. I'm not as good at exiting as I wish I were. But it's, setting yourself with some basic parameters of your exit strategy, because if you're going into something, you have to be thinking about, when am I getting out of this? Yeah.
Well, do you know what? It's one of the things I posted on, in fact, one of the best sort of interactions I've had for a long time. But I said, where most private investors, why most private investors lose money is they don't think about the risk. They only think about the reward. And they go into a stock thinking, how much money can I make in this company? And they think, if I can make, say, if I put £1,000 in and it's going to be a 10 bagger, I'll make £1,000. So I'll put 10 grand in and that'll be the entire portfolio. No. First and foremost, there is no reward at the start. It's just risk. You're risking your capital. So think in terms of, how much can I lose here if it goes completely wrong? Because that's worst case scenario. And if you can protect yourself against that, then you're okay. If your portfolio doesn't take a massive hit, if it all goes wrong, because it can, especially if you're investing in very high risk stocks. So thinking in terms of risk first. Once you start getting the profit on that, then you have to think, okay, how can I manage that? But first and foremost, it's about risk management. And then when you get into profit, it's about risk and reward management. But first and foremost, focus on the risk, not the reward. That's the problem. People just see the upside, not the downside. So when the downside happens, and inevitably, it will happen in one or two stocks you have, you haven't got a plan for it, because you haven't planned for it. You just plan for the reward. You haven't planned for the risk. So plan for the risk first, because first of all, you are risking your capital, and you haven't got any reward there yet. So the reward is in your brain. You think you will get a reward. It's fantasy at the moment. So, think about risk first. Anyway, bit of news on Polarian, which is, I suppose, good news. So a US patent granted for dynamic cardiopulmonary blood flow imaging with xenon MRI. What's this about?
So remember, they got an approval, right, for their technology, and it was a first approval, and it's a very important one. It's the broadest one, kind of the ones they're going to be seeking, throughout they have other plans for this technology, is my point. This is one of their other plans for the technology. So the first one that they received, so this is FDA approval for basically they want to check how your lungs ventilate, okay?
Yeah.
But remember, this is a contrast agent, so the xenon is inhaled and it lights up on the MR, scan, showing you that the gas goes where it goes in the lung, okay? And that's what ventilation, okay? So the first approval was with what's known for ventilation defect, which means that lungs are obstructed, lungs get, affected by, say, a tumor, lungs get affected by a disease. So all of a sudden there's parts of the lung that don't ventilate properly. And that's a major cause of concern. And that's what you're trying to diagnose through ventilation defects. So you're trying to see where in the lung air isn't getting to, right? That's a very mechanical one, okay? Another one they're seeking down the line is gas exchange. Okay, so they're going to need an approval. They're going to need to do work on that in terms of clinical trials, etc. But that's a future use of this technology as well, which is watching the air go into the lungs. Okay, and this is all the same contrast agent. It's always xenon, and then watching it exchange with the blood. Okay, so that's how you get oxygen into your system. Is the gas exchanges with your blood. So CO2 comes out and oxygen comes in from the air in your lung. So that's a second functionality that's quite important in your lung, because you can have areas of your lung that ventilate well, so you get air into them, that's perfectly fine, but it doesn't exchange because there's something wrong with the lining, okay? Yeah. And there's certain, like for example, there's a condition called fibrosis of the lung, which you can't see. It ventilates perfectly well, but it's not there's no gas exchange. So that's a secondary function of this technology, which is very valuable, and they intend to develop it. this is another one. This is they're looking for basically blood flow imaging. Okay, and basically you can actually test as literally as the patent describes dynamic blood flow. And that is a whole other category of potential diagnostic capability of this technology. And the idea is to make it far more less invasive than current measurements that are in place. Right? So it's interesting to show. It's a good patent, and it's good for the technology. It has multiple applications, future applications. Obviously, they will take money to develop this, and this may not be the best time in the company's shares to be talking about future applications. Like the shares are suffering quite, as you said, steeply because they're a bit tight on cash. But back to just the technology, from a technology standpoint, it's good news. It's good news because it shows that the company is thinking about the future and its future applications over and above the current applications.
Yeah. Do you know what? I said, I fell in love with the story, and it's a dangerous thing to do. Because literally, you should, it's one of the things I talk about in the book there, but looking at financials rather than stories. Don't fall in love with the story because you literally ignore everything else, and you shouldn't ignore it. The story is important, of course, in any company, but you've got to keep an eye on the numbers as well, because that tells the true story.
Absolutely, I think that's important. So is this announcement like game changer? Right now, it isn't. Right, right now. The fundamental issue with this company, and we've discussed it at length in the past and here today, is there are certain things in a company, especially in a down market, that dwarf anything in the story, and that's the runway, the cash runway. So that's the story right now in this company. Everyone's concerned about the cash runway. So irrespective of what we talk about the future of the business, no point in talking about what the business can do in 5 years' time if we can't get through the next year, right?
Yeah, exactly. And it's a pity because I hope this company does really well because, like I said, the technology seems amazing. It does seem like cutting edge. It'll help a lot of people. But hope is not an investment strategy. You've got to have other things that go along with that. But like I said, I do hope it does very well here. And like I said, if we start getting some commercial orders or something, which we need to see, then maybe I'll get back in. But at the moment, like I said, it's a very difficult market. So many coming. Yeah. I heard a stat. We'll finish on this, but I heard a stat, I think it was on Radio 5 Live, and I can't find the article, but I walk in the dog and I'm listening, and the podcast, is that 73 companies have delisted from AIM in the last year, apparently. And I think, wow. And that seems a lot. I mean, it's a
10% drop. There's about 700 companies on AIM, ballpark. So it's about a 10% drop of companies on the market.
But I'd like to see, though, a comparison stat on previous downturns, because I assume this is relatively normal-ish. I mean, this is inflation, interest rates, induced. So maybe it is harder for companies to raise on AIM, which is what a lot of companies list for. That's the primary reason, to raise money, capital. Yeah. So I would like to see a comparison to previous downturns, see if that's in the ballpark. So I assume it would be the similar kind of story, wouldn't it? Whenever a downturn,
for sure, in downturns there are delistings, definitely. I think kind of AIM had its heyday in 2007 was the last year of the rally, and at that time there were 1,700 companies on AIM. So AIM's come down a lot over the last 15 years.
Yeah.
So I think in 1995 it was when it was established. It had 12 companies, right? So it went from 12 in 1995 to 1,700 in 2007. And now it's at about 700. So that's
that chart there, right? That's the weekly chart of AIM. I mean, 1999 it started, but they started indexing it on TradingView in 2002. Yeah. That there is an excellent example of why AIM is a stock pickers market. It's not, people say because even back at May 2006, it was at 1,300 pretty much, and it recently reached that high. But it's now back down at levels, it's been in these levels for 5 years. So it's not gone up, and that's the whole point of AIM. It's a stock pickers market. It's not a sort of index you would buy a tracker on because there's so much. It's good companies and some really bad ones as well. So in fact, some really good companies, but people just because there's a lot of bad companies that takes the attention away from the good companies. But it's a stock pickers market. It's not something to index. But like I said, it's a market of stocks, and there's some decent businesses in there. As an investor in individual companies, that's your job to do that. And inevitably, you will find a bad one, and it'll hit you.
One thing that's
a bad one. It can hit you anyway. A good one can hit you. So there we are.
One thing that's clear from this chart is look where we are. We're in one of the deep troughs right now. So, I mean, it could go lower. It's true. I don't think it will. I think we're pretty much at the bottom end. But look at what happens when it goes back. I mean, look at that difference. And in any given stock, you're absolutely correct. This is not an index market. It's all about stock picking. But even on if the index is doing that, some of the winning stocks are doing even more, right?
Yeah,
to drive that whole index up.
Yeah. It's down 49%, and that's including the winners.
That's exactly. So imagine what happens if you pick winners now and you have that rally, in the whole index. What do you think the winners are doing?
Yeah.
They're doing
do you know what?
5 times that rally.
Bit of news for you here, right? I looked at my, so I'll finish on this. I looked at my MicroCap League, and I got the 10 best, highest ranked companies on this league, okay? And since January 2023, which is, let's go back to that. So from here, pretty much, they've done 65%. The average of 10 of them. One of them's done 400%, some of them's done 100%. But the average is 65% gain when AIM's gone down 10%. And so, it's worth it. The MicroCap League is very good. It just ranks companies on fundamentals and momentum, so it works out. Anyway, thanks for that, Vadim. I'm a minute over. Apologise for that. We'll speak to you next week.
All right, thanks, Justin.
The SharePickers Podcast with Justin Waite. The content of this podcast is not intended as investment advice. It is for information purposes only. People in this podcast may hold positions in the stocks they talk about. Do not buy anything based solely on a tip or recommendation. Please do your own research.